Hi everyone, I'm David Scranton and thank you for clicking on today's video. You know, inflation was the main theme of my last market update show. And guess what? That's right now inflation is still the main economic conundrum that faces consumers, investors, and the markets. The stock market is down over 10% based upon almost every index out there. Interest rates are rising and fears of a new recession are rising too. So what does it all mean for you? Well, we'll let you know on today's market update show. Specifically, we'll cover where inflation stands now and what the Fed's doing about it, its impact on stock and bond markets, why many are worried about a new recession, and most importantly, what you can do to protect yourself. So first, let's look at inflation. You know, the numbers that just came out this past week imply an inflation rate over 7%. Last month, we saw an implied inflation rate of 8.5%. In fact, I don't like to take 1 month's increase and multiply it by 12, but when you look at that over the last several months, it's been stubbornly in that 7-8% range. And if you're talking 8%, it means the highest year-over-year increase in the cost of goods and services, the CPI index, since December of 1981. That's over 4 decades. And of course, there's a lot of finger pointing, right? Who's to blame for soaring inflation? But bottom line is this, there's no denying that the problem began because the fallout from the pandemic. Demand increased while supplies decreased. Though today's inflation may have risen from natural economic sources, many say no way. They blame the Federal Reserve for letting it get out of hand. Because for a lot of 2020 and most of 2021, the Fed insisted inflation was transitory, insisted it would take care of itself. And that changed toward the end of last year when inflation actually hit a 30-year high at that point of 6%. And that's when the Fed announced a plan to start raising short-term rates throughout this year to try to rein in inflation. So with that, the market started getting chaotic. And the chaos has just gotten worse. So the chaos has gotten more chaotic. So far, the Fed has approved 2 rate hikes, a 0.25% rate hike in March and a 0.5% on May 4th. That gets the federal funds rates up to 0.75% to 1%. Now, in addition to raising those short-term interest rates, the Fed announced in April that they would begin plans to manipulate long-term rates upward. How do they do this? By unwinding quantitative easing programs that have actually been in place since the heart of the pandemic, March of 2020. And that announcement triggered more chaos, which includes a sell-off in the bond market as interest rates soared, and also a pullback in the stock markets. As far as interest rates are concerned in the bond market, in April, the interest rate on the 10-year government bond rose by 0.5%. And this is the biggest jump it's ever had in a given month since 2009. And so far, year to date, the 10-year government bond yield went from 1.5% to 3%. It's doubled year to date. So why is this fueling so much chaos, so much concern? Well, we can answer by focusing on the bond market. Since the beginning of the year, bond investors have been reacting to the Fed's tough talk with sell-off after sell-off, driving bond prices down and long-term interest rates up, right? And these sell-offs occur partly because bond investors are concerned about creating a flat or inverted yield curve. And that's what happens when the Fed raises short-term rates to a point where they become equal to long-term rates. Thus the term flat yield curve. And the bond market and a healthy economy wants to give the Fed enough room to raise short-term rates without flattening the yield curve, because the flat yield curve is considered to be one of the most predictive warning signs, historically speaking, of recession. In the trouble, though, is that an inverted yield curve also occurs when interest rates on these short-term bonds rise higher than those of longer-term bonds. And that did happen earlier this year. And in response to that historically predictive sign of recession, the Fed then announced this aggressive plan of reversing quantitative easing and trying to manipulate long-term rates upward. The market's concern is if it's too aggressive, it could create a recession, even if not this year, maybe last year. And part of the reason for that is that the economy is already seeming to be slowing down just a little bit. And raising short-term rates by its pure nature will slow it even further. And this fear increased when just last month the report came out from the Bureau of Economic Analysis that the economy shrank by 1.4% in the first quarter of this year. Now, that surprised a lot of people. So as you may know, the definition of recession is at least 2 consecutive quarters of economic shrinkage. So if the economy contracts again in the second quarter, where we are right now, then we will officially be in recession. So how likely is that? And what does it mean for you? Well, with all the data considered, I really don't think a 2022 recession is very likely, and Wall Street doesn't seem to think so either. To me, it looks like big investors are pricing in the possibility of a recession in 2023, and historically we know that typically when you have a flat yield curve like we had at the end of March, beginning of April, it's at least 9 months before that causes a recession, which puts us certainly into 2023 at some point. And whether or not we even have a recession in 2023, yes, depends largely on the Federal Reserve, because growth is already slowing naturally. If the Fed moves too quickly and too aggressively, then a recession indeed might just be inevitable by next year. Analogy I always make is it's like chemotherapy. Chemotherapy to a patient is essentially poison. The idea is to give enough poison to kill the cancer, but just stop just short of enough poison to actually kill the patient. Well, the Fed is essentially using economic chemotherapy to solve this inflationary cancer, but if they use too much of it, they might kill the patient by pushing us into recession. So the Fed has to move cautiously, in fact, has to move more cautiously than they're indicating. All the same, you can't deny that these market conditions create challenges as someone who's approaching retirement or someone who is retired. Because as noted, the stock market's been down since the beginning of the year, meaning that if you're focused on growth or capital appreciation, your portfolio is probably in the red year to date. Meanwhile, long-term interest rates have gone up, so bond values have come down due to the inverse relationship between interest rates and bond prices. So you have bonds down and you have stocks down even more. And that creates a headwind for people who are income investors who are trying to make that transition because you're down in value from where you were just 4.5 short months ago. But I'm here to tell you that the situation isn't as grim as you might initially think. Why? Well, first, when you're in a more conservative portfolio, something that generates income, most of your investments have a fixed dollar payment of interest or dividend, and that dollar payment doesn't change regardless of decreases in values of the actual investment. Second, many of these instruments have a par value or a face value, which doesn't change regardless of any fluctuations in value, which means that if you hold it to maturity, you're guaranteed to get your principal back, provided that the companies that you're invested in have not gone bankrupt. So of course, you have to be diversified. And as I often explain, when you invest conservatively for income, it means that any loss is really truly a paper loss. Because remember, it was only 4 short years ago, it was 2018, when we faced the same types of challenges with interest rates. And for largely the same reason, the Fed was raising short-term rates and the market was trying to accommodate them and raise long-term rates. Today's interest rates haven't even gotten as high as we saw at the end of 2018 yet. And remember, that was pre-pandemic when they peaked and started coming down again. So by the end of that year, 2018, that I'm describing, the market shifted because the bond market said enough is enough. We're not going to raise long-term rates anymore. The Fed stopped raising short-term rates, and that allowed bond prices and stock prices to start to come back and recover and have a very nice return in 2019, assuming that you weren't in investments that went bankrupt or assuming you were diversified. Okay? So what does it mean for now? Well, I'm confident that's going to happen again. In fact, doing this 35 years, it's happened every time there's been that drop. We've seen that recovery. Well, to help me break it all down is today's special guest, John Najarian. He's an options trader and co-author of the book, follow the smart money. John, it's always great to have you here on the Income Generation.
Great to be with you, David. Thank you for having me.
So what's going on? I mean, earlier this week we got the CPI numbers. Inflation is persisting, but we get a negative GDP surprise in the first quarter, which I don't think expected. So how do you put it all together? You put it in a blender, push the button. What does it mean?
Well, because they've stripped out food and energy from what the Fed really tracks, they do keep track of the rest of it. Again, food and energy, because we all got to eat and most of us have to drive, or at least the stuff we're going to eat has to get delivered. And most of that is done by fossil fuel powered vehicles. But I think overall, the inflation number was still hot. Wages are not staying high and elevated. They're instead coming down. And that is a dangerous two-edged sword that people worry pushes us towards stagflation.
Right.
When people can't afford goods because those goods are a lot more expensive and they're earning less. Clearly, they're earning less at the same point as last year, given the inflation and everything that they buy has become more expensive.
Yeah, that stagflation word, it's funny. I was on an interview myself just about 6 months ago, and I mentioned that it's a possible outcome. And I remember the host of the show saying, stagflation? Really? And now, of course, it's becoming a reality. So the Federal Reserve, do you think it's all big talk in terms of how many interest rate hikes they're going to make? Do you think they're going to continue to try to do that, maybe causing a recession?
I think they're very aware of exactly what you just broke down, Dave. So they obviously don't want to do that. But they either believe or they're mouthing the idea that they can quell inflation by moving up interest rates. And this inflation that we've got right now will not be quelled by those interest rate moves, because this inflation is because of cutoffs out of Russia, Ukraine. You and I have talked about it incessantly.
Right.
So all of the inflation is not on Mr. Putin, but the last hockey stick side of it is on that war in Ukraine, which we can pretty much hang squarely on the shoulders of Mr. Putin. So I think overall, the Fed knows they probably have at least one more 50 basis point move, perhaps two. 75, I believe, is off the table. And again, they can hit it as hard as they want, Dave. All they're doing is causing more pain for consumers at that point, and more pain for the US government that has to finance its debt at record levels, at not record prices, but at significantly higher prices than they were financing it at over the past several years.
Yeah, I've likened it recently to chemotherapy, right? Chemotherapy to cure a cancer patient is essentially poison. So you want to have enough poison to kill the cancer, but just leave it this short of enough to actually kill the patient. And that's what the Federal Reserve is trying to do. The problem is there's something else feeding the tumor right now that the chemotherapy, the economic chemotherapy, can't solve, and that's the supply side of it.
Yep, very true. And right now, Dave, we've had a little bit of easing on the energy side because of the China lockdowns.
Right.
So obviously,
temporary easing.
Yeah, factories not operating as much. People not traveling to and from cities to those factories and so forth means demand for diesel and gasoline is quite low. It's not zero, but it's much lower than it was. When that kicks back in, you can pretty much expect to see the consumer here feeling even more pain. And I'm not happy to be bringing that news to folks, but when that happens, it might be coinciding with the summer driving season, which kicks off in just a couple weeks.
Yeah, exactly. My sentiments too. We're seeing a little pullback in fuel prices, but we're not going to be able to see any permanent pullback until the fall. Another thing that I think they're just starting to talk about now, and I know you and I talked about it in the past, is corporate America spent about a 5 or 6 year period where they were short on capital expenditures to begin with. So we were running up against the supply limit of goods and services anyway, because corporate America was depreciating everything, but they weren't investing in CapEx. And that's something that most people didn't realize, that we're coming up close to that limit. And then when you intentionally shut down the economy and have all the pent up demand that results from that, and how long it takes to get the economy opened again, it's no wonder why we're seeing what we're seeing, which means more could be driven from the supply side problem than even the demand side than economists even give credit to.
Right. And exactly what you're saying is playing out in real time.
Yeah.
And so that's, like I say, it's a dangerous mix. It's one that, every once in a while, I thank goodness that Joe Manchin stood his ground and didn't participate in another 3 to 5 trillion, which the Congress and the president wanted to throw at this market. Can you imagine? I think inflation would be 11 to 14% if they'd done that, Dave. And so as bad as it is right now, it would have been much worse with another 3 to 5 trillion thrown into the mix.
Yeah, I agree completely. It's crazy. Now, the good news, I think, with all this volatility, you've probably been able to help some of your clients make some money in the options market, I would assume, right?
Yeah, well, and just as a very quick example, when volatility in Apple, biggest company in the world, when that goes from 27% where it was a week ago to 40% where it got to, just in the middle of this week, that means options or rent, if you want to look at it as an apartment, that rent just went up dramatically. It went from $4,000 a month, which is what you'd be getting for a 10 lot of call options that you wrote against your Apple stock, to $6,500 a month. So again, as far as getting more rent, anybody that's a landlord loves that. And who doesn't like it? Of course, the person who's paying that rent. But at least in the case of this, the consumers that we deal with, our clients, are happy that they're able to collect that more rent rather than being the other side of that trade.
There you go. It's and of course that's a strategy that's actually appropriate for members of the income generation, because they're not speculating; they're just basically, increasing the income. So whatever dividend you have on your stock now gets tripled or quadrupled with the extra rent that you mentioned. So, okay, stagflation's a definite possibility, but it doesn't mean recession. But your best guess, will we see recession in 2023?
2023, that one's tougher. The rest of this year, I think we will avoid it. Right. 2023, it really will. If you and I had that crystal ball, again, I said at the top, I don't think the Fed's going to drive us into a recession or with stagflation as another risk out there.
But inflation alone could cause a decrease in demand destruction, just because people pull back and say, I can't afford it, especially what you said before with wages wage increases going in the wrong direction.
Right. And as we both know, somebody's recession, everybody feels it differently, but how the government and how economists measure it is 2 quarters of negative GDP. So to answer your question, I don't think we see that this year. Next year, it is a possibility. But again, I hope that cooler heads prevail and they don't do that.
You and I are on the same page, so let's hope and pray together. And I'm sure we'll be talking soon enough in the next couple months to see whether the Fed does only 1 or 2 more 0.5% increases and has the wisdom to push the pause button at that point. John Najarian, always my pleasure. Thank you so much for being with us here on The Income Generation.
Thank you, Dave. Have a great weekend.
You too, my friend. Thank you for watching today's market update video. If you enjoyed it, click the thumbs up button to give us a like, and make sure you subscribe to our YouTube channel for new content each and every week.